We are back at the Insight Empire. This is the Blue Ball Forex, of course, your best friend and #1 mentor and coach. And today, guys, we are here to let you know of the easiest Forex trading strategy that we are already using. And yeah, as you can see, we just break evening right now because I added some martingale layers. But yeah, I shared that same entry here, and people went in full margin. There is no full margin, bro. Full margin. Full margin means the maximum lot that account can host. It is not a very sustainable philosophy, but it is the only philosophy that can enable you to manufacture $2,000 before sunrise, or even before other people know what is happening. I am in slight drawdown because I added some martingale layers as the market was trickling down, and I'm going to hold that entry. By the way, this is a live trading account. This is a live trading account. So my target is $5,000 for this particular account. It's currently at 2,800. Why am I so, but I wait first, I hit the TP, then we continue. Anyway, now this is the thing. This particular approach is actually very, very simple. It's called supply and demand, and I'll be breaking it down because from this particular point we've been cruising down, because you can see these are completely zero drawdown trades. So I'm gonna be breaking it down. How do we basically take these zero drawdown trades, because that is something that you need for you to open a big lot size in your trading account. And just to be honest, sometimes the lot size is proportional to the lifestyle you live. So it's very critical. So for you to reach to a point, you can open a lot size of 1, lot size of 2, lot size of 3 in an account, let's say even of $2,000. Might look like over leveraging until you see my risk. Okay, I'm into a point where my stop loss does not go anywhere beyond 10 pips. Okay, so it's big calculated risk, and that is a philosophy of a guy called George Soros. Go and check him out. He's an author of an amazing book called The Alchemy of Finance. Anyway, now breaking this down on how we were able to take this particular trade, we used a very simple strategy, and if you master this strategy, you will stand out 90% ahead of any other retail trader. So let's break it down slowly to how we were able to catch such a sustainable move, because right now we're floating, let's say, of how many pips from this particular side. This is almost 80 pips. Actually, if I did not have those martingale layers, I would be in deep profit. But anyway, now let's talk about this strategy. It relies on two things. The first one is liquidity. Now, liquidity is the most important part in trading. Liquidity is the most vital concept in trading, because basically the forex market moves because of three technical reasons. The first reason why the market moves, it moves to look for liquidity pools. Hunting liquidity is the constant mission of any market, whether crypto market, stock market, forex market. The algo that engineers the forex market is designed with the same concept, which is which we call the chaos theory. Of course, the market is the most chaotic entity alive. It is the most unpredictable thing. Actually, we don't predict the market; we only anticipate. Now, talking about the concept of liquidity, or why the market moves fast to hunt liquidity, is because the liquidity is very important to run the market. The second technical reason why the market moves is to rebalance imbalances, and the third reason why technically the market moves is basically to equalize demand and supply. So we are talking about two technical reasons why the market moves in this particular video. The first one, why the market moves to rebalance supply and demand. That is the first reason why we're gonna be talking. And the second one, we'll be talking about why market moves to hunt liquidity and how we can be able to leverage on that particular liquidity. Now, let's get into the business. First thing first, how is liquidity swept? How is liquidity swept, and which liquidities do we have, so that we can now come to the concept of supply and demand, which is the aid to this particular end. You can see how it's pushing down. Now, the first thing, we have two major types of liquidity. We have external range liquidity and we have internal range liquidity. Now, external range liquidity is basically liquidity that lies above or below old highs or old lows. Old highs and old lows is the 7 institutional reference points in the order of institutional reference points as they were taught in the ICT. Now, every old high and old low, there lies external range liquidity. And now this is basically people's buy stops and sell stops. A buying stop loss is a sell stop. and a selling stop loss is a buy stop. I'll make that make sense later. But now, this concept is very key. Now, let me explain external range liquidity in layman's language. Now, assume this is old highs and these are old lows. The implication to that is people who are buying at this particular point, for example, these are concepts I've taught for so long here. People who are selling at this particular point for sell positions, okay, those support and resistance traders. So we have a resistance zone here, and so people are selling at that particular point, and then they, of course, they have their stop loss because they like using stop loss, which is another reason they are not profitable. Now, if they put their stop loss below the most recent low here, it means this particular zone is a point of liquidity. Why? Because this is stop loss is an interest of the market maker. Okay. Now, if they put their stop loss above here, this stop loss is an instruction from them to their broker, telling their broker, if the market buys above this particular point, you should close the market with a loss. So this is a buy stop to stop the market from buying further. That is one. Now, if the market comes down over here, they of course be selling around, they of course be buying at this particular point. Of course, they are taking buys here, targeting the previous high. Let me show you how these people always almost get duped up by the price. So we're gonna have a stop loss down there and then the target to the previous high. So if they are buying here, they are telling their broker, if the market goes down beyond this particular zone, please lock my remaining capital with a loss, close the loss. So this stop loss here is a sell stop, telling the broker, please stop selling further, stop my trade from the current position so that it should stop eating on my capital further. Okay, now these zones here are liquidity zones and they are interest of the smart money. Now this is why this is very important. So at some point the smart money will intentionally come up, take this liquidity zone and then target the previous draw of liquidity, which is particularly this liquidity. So you will discover sometimes where you are expecting the market to reverse from, it does not. And this is one of the technical reasons why retail traders lose money, because number one, they are so predictable. And that is what I'm teaching you not to be. Okay, assume you are the market maker who wants to take money from a retail trader. Of course, they are buying from the support, and of course, if they are buying from the support, where are they putting their stop loss? Of course, below the support. So that predictability makes them vulnerable. Okay, so the more you learn how to enter your entries. By the way, two things are very important, and one is more important than the other one. Where you get in the price and where you get out of the price. Now, here is the thing: getting out of the market is more important than getting in. Please note this down. Getting out of the trade is thrice as important as getting in the trade. Because you can get in a trade, make money and still blow the account. So exit is very important. That's why the Bible says it's better the end of a thing than beginning of the same thing. Anyway, not the same concept though. But where you enter the price is very important, but it's more important where you exit. And now today we're talking about the entry first before anything else. Now, when you look at this market, for example, from this side and this other side, these are liquidity zones. So what do we want to know? We want to wait for the market to sweep liquidity to the downside. Okay. And how do you know that the market has swept liquidity? If market is sweeps liquidity, if it closes above, if the market moves above the previous high and then closes below that particular high with a wick, not a body. If it closes above here with a body, for example, let's assume these are candlestick. Hypothetically, let's assume this is a candlestick. My candlestick is not very sexy. Let me do some adjustments. So let's assume that is a candlestick. Okay. And this retail trader is waiting for the candlestick to close, and then the candlestick closes above this zone. Now this marks this zone has already been broken, and so the next thing to do is not to wait for a reversal, is to join the trend, is to know that the market is in a continuous trend. Now it has no probability of reversing there, but some point this market might decide to reverse, but with a different manner. Have a look here, for example. We have this wick here. Imagine how the market decides to reverse down, go up and then comes down completely, leaving a wick above this particular point. You see that wick? Leaving a wick up at this particular point. So where this wick happened and closed below, this is a sweep of this particular liquidities here. So you want to see the market close here before you can enter. Now, the worst mistake people do is to enter immediately. If the market has not gone above this particular zone and then it retraced with a body, you don't have any reason engaging that supply zone. Now, let me make this make sense in layman's language. If you enter before the market sweeps liquidity, you will become part of the liquidity. It means you can't see where the liquidity is. And anytime you're trading and you cannot see the liquidity, my brother, my sister, you are the perfect liquidity and you're just about to get liquidated. And it's not a very pleasing thing, honestly. So this is what you want to do. You want to enter the market exactly at this particular point. All the sweep has already happened. You want to enter your market exactly at where the market will have closed, and make sure that your stop loss is just above that particular sweep where the market was swept. Okay, and then you target the previous low, and in most cases that always happens. Now let's break this down to how we were able to take the trade based on the same approach with my community in our group. Now this is what happened here. So we saw this particular market here, and we knew there is external range liquidity lying above this particular reversal. As you can see, we had a deep reversal from where this candlestick basically reversed back. This is a very possible high, and so we drew our line there, our liquidity line there, and we were sure that this market will at some point sweep this liquidity. Now look at what happens here. This candlestick moved up, filled above the zone fully, and then you can see what happened. After it filled this particular zone, it reversed. It reversed and closed here. So now this was our perfect entry. We entered exactly at this particular point, and then of course we had our stop loss just above that particular place. But I've done an extension of our stop loss just to give room for the market to play out, because so many people are basically trading in my VIP group and this particular community. So I was quite sure that if I give a much more extension, because the stop loss was something about 25 pips or something, so I decided to make it at least 30 pips or 40 pips so that these people can have a longer stay in the market, because either way the market is still giving us a good risk to reward ratio. Remember, we are targeting this particular zone, which is actually giving us a 1:3 risk to reward ratio. Now, for you to be profitable, you need 40% win rate with a 1:3 risk to reward ratio. That's simple. The problem is you are looking for 100% win rate with a 1:1 risk to reward ratio. So you can make like 8 trades, good trades, but 1 trade and then you are back to 0 again. So that is how simple we took this particular trade. And so now, how do you know it's a supply or support? It's a supply or a demand zone. So a supply zone is where we have a buyers and sellers engaging in the market, but at that particular point, we have the sellers exceeding the buyers, that is in terms of volume. For example, if you have a market moving up, down, up, down, up, then it decides to range within a specific zone. Okay, so these are buy market ranging at a specific zone. So 2 things. Why is liquidity important? First, where this market is ranging, people are putting buy stops and sell stops. For example, this particular point here. Okay, so at some point the market will sweep this liquidity. It has to take the money first and then push down. Think about it in this line. It's like a nightclub, okay, where one big musician, those celebrities is coming, and so all the village people have come to the nightclub, and the bouncers are pushing the people away because there are so many and they are not likely to pay, of course. So the nightclubs are pushing because they don't want these people to enter this particular event. So these people are too many, and at some point they overthrow the nightclub bouncers and they enter. They drink alcohol for free and they still celebrate and enjoy the nightclub life even for very little. Now, this is basically the same concept. So nightclub pushing, then we break down. Whoop. So this one is called a rally here. This initial movement, this is called a rally here. This is rally. Oh, Jesus Christ. Rally. Then we have a base, which happens here. This is called a base, and then we have another rally. Okay, then we have another rally. Now here is the catch. Why do we rely on support and resistance? Not avoid that thing. Why do we rely on demand and supply? Now we like demand and supply because most often where we have a base, it's a consolidation phase. Now the bigger the breakout, the bigger the consolidation, the bigger the breakout that is supposed to happen. So if we have a market consolidating at a specific point, we are sure that any break that will happen either to the downside or to the upside, it's likely to be a very strategic rally. Now that is the same concept. We can even have another one where the market goes up, consolidates, and now this is a rally, then we have a base, and then we have another rally. Okay, we have like another rally. So it must not always be this format. It can be this one being a rally, the market rallied up, and then we happen to have a base. Let me clone this. This is a base, and then we have another rally. Amazing stuff. So that is basically how simply we take advantage of this particular trade. Now, for example, this one, you can see this was a consolidation phase, a very clear consolidation phase. And so we waited perfectly for the market to sweep this particular external range liquidity, and of which it did. Of which it swept this external range liquidity, and then it dropped. Why? So what are we expecting? We are expecting this. We had this particular consolidation here. Initially, market range. Even all this is a range. Actually, this market range like throughout. If you look well, how do I have a good this one? If you look well, that is something like a range. Then market rallied down, but now it has revisited the range. But we are interested in the range from its utmost high. Why? Because the key to profitability now. let me speak this in the most simple language. The basic and the basic strategy on earth is ability to buy low and sell high. But now the question becomes, high of what? Because sometimes you buy at the low, and then another low is created, and another low, and another low. Sometimes you sell at the high, then the market makes another high. So we are trying to look for possibility to sell at the extreme high, of course the highest point of this particular range, and then inside this one, do we have a raise to confirm that we are supposed to sell? So that is exactly how we ended up taking this trade. So I'm going to do another more comprehensive video to explain to you much more and more about this particular strategy, because it's actually very, very easy. In the next video, you're going to be finding part 2 of this particular video as I break it down to make more sense to us. I'm the Blue Ball Forex, of course, the #1 market mover in the country, and see you in the next one.